Every country on Earth is drowning in numbers so large they barely feel real. The United States carries $38 trillion in debt. Japan, $9 trillion. The entire planet, roughly $315 trillion, about 3 times the size of global GDP. But the true nightmare isn't the size. It's the paradox buried beneath the surface. A paradox that should not be possible in a rational world. If every nation owes money, then who is the creditor? Who stands on the other side of the ledger? Most people picture a single villain, a foreign power, a billionaire, a shadowy cabal. Yet when you trace the chain of ownership, when you follow every bond, every institutional balance sheet, the answer is unsettling. The world doesn't owe money to someone out there. It owes money to itself. The debt is circular, internal, recycled through pensions, banks, central banks, insurance companies. Still, the interest keeps rising, payments keep flowing upward, and the system keeps tightening, generation after generation. This was not an accident. It was designed. Across 3 centuries, 4 men, 4 financial architects introduced 4 mechanisms that locked governments into permanent indebtedness. This is not conspiracy. It's documented history. The meetings occurred, contracts were signed, institutions were chartered. Once you see how they fit together, you'll understand why $38 trillion isn't a crisis to solve but an operating principle, the machine doing exactly what it was built to do. Before the late 17th century, kings borrowed like desperate gamblers. A monarch in need would go to a wealthy merchant or noble, promise repayment with interest, and hope the war or harvest went in his favor. If a king failed, creditors lost money and the ledger reset. Debt was temporary, finite. It healed or it broke. Then William Paterson, a Scottish merchant with grand ambitions, proposed something radical. England, at war with France, had an empty treasury and exhausted lenders. Paterson offered to mobilize wealthy merchants to lend a large sum to the crown, but on terms that would change finance forever. The principal would not be repaid. Instead, the government would pay interest in perpetuity. The loan would be an annuity. To manage this arrangement, Paterson proposed creating a new institution, the Bank of England. Merchants would deposit gold with the bank would lend it to the government would pay interest out of tax revenue, and the bank would pass that interest back to the merchants. The genius in the trap lay in the permanence. Parliament guaranteed the interest payment with taxing power. As long as the state could collect taxes, the interest would flow. Merchants received banknotes in exchange for their gold, notes that were tradable and, crucially, that paid interest. For the first time, government debt became permanent and liquid. Debt was no longer a temporary burden but an asset class. This arrangement created something even more consequential: money created from debt. The Bank of England could issue banknotes backed by government debt. The government's IOU became currency. The more the government borrowed, the more tradable paper money could circulate. For lenders, it was effectively an eternal annuity secured by the state. If a merchant wanted to exit, he didn't wait for repayment. He sold the claim. The debt could be transferred, traded, repackaged. The principal was effectively removed from the equation. Interest became the recurring stream that mattered, an endless transfer from taxpayers to holders of government credit. Within decades, other European powers copied the model. France formalized national borrowing. The Netherlands had sophisticated financial markets. And by the 1792nd, the United States consciously modeled its system on England's. Alexander Hamilton explicitly looked to the Bank of England when structuring America's financial foundations. Perpetual debt, interest serviced by taxes, bonds treated as secure assets. The innovation didn't just fund wars and roads, it changed the relationship between states and creditors. Debt became structural, not incidental. Paterson did not die a fabulously wealthy man, but his architecture outlived him. The Bank of England still exists. British national debt has never been paid off in the sense of eliminating principal. It has been rolled over, refinanced, expanded. The debt trap permanent public obligations paid by future taxpayers was set in 1694, and successive governments walked willingly into it. Permanent debt made the system profitable for lenders, but it did not by itself make default impossible. That required turning national liabilities into tradable, cross-border assets and creating a distribution network that could move capital faster than state communications. For that, we meet the Rothschilds. The Rothschild brothers began as money changers in Frankfurt, and by the early 1800s they had banking houses in London, Paris, Vienna, Naples, and Frankfurt. Their network was unprecedented. Couriers, correspondents, intelligence, and vaults spanning Europe. Nathan Rothschild in London became the linchpin, arranging loans for governments during the Napoleonic Wars and, crucially, inventing a secondary market for sovereign debt. Instead of lending directly and waiting, Rothschild bought government bonds and sold them to a broad investor base: pension funds, insurers, wealthy individuals. He created liquidity and, by extension, demand. Governments that needed money could access it quickly. Investors received tradable assets. But the deeper innovation was structural. By enabling bonds to be owned across borders, Rothschild made sovereign debt part of a vast, interconnected web. A British bond could be owned by a French investor, sold to a German bank, used as collateral in Vienna. The web of claims made default no longer an isolated matter. It threatened a cascade. When debt is diffuse and interlinked, the cost of default is systemic collapse. Rothschild also mastered information asymmetry. Fast couriers and an intelligence network let him know events, victories, defeats, policy shifts well before markets did. By timing sales and purchases, he engineered spreads that yielded enormous profits. Whether through superior logistics or market sway, the Rothschild model centralized control over issuance, distribution, and pricing. The consequence was that governments became entangled in markets so broad that a single sovereign failure could reverberate across nations. Default ceased to be a sovereign choice. It became a systemic threat. By the 19th century, what Paterson began as a way to fund war had become a global infrastructure. Perpetual public debt turned into an international tradable asset. But still, missing was a mechanism to assure limitless demand. Banks and merchant networks could only stretch so far. The 20th century would supply the next leap: centralized banking with the power to create money. Before that transformation, however, realize this: the chain from gold in a vault to a government IOU had grown long and complex. A lender's income no longer depended on goods produced or services rendered. It depended on the state's ability to tax and on markets' belief that interest would continue to be paid. The system had been rewired so that interest payments flowed upward like a slow tide, and the holders of claims, not kings or producers, became the ultimate beneficiaries. Pause here. The trap is now visible: debt made permanent, made liquid, and set up to flow indefinitely. But the net did not yet cover the globe. To see the full snare, we must continue, because the next architects would make default politically and economically unthinkable, and the modern central bank would make debt effectively limitless. The story is not finished. It's only beginning. What began with Paterson as a national mechanism would be forged into something far more powerful in the hands of Nathan Rothschild, a system where sovereign debt circulated across borders like lifeblood, pulsing through every major financial center. By the early 1800s, Europe was a continent at war, and governments needed money desperately. But unlike the kings of old, they weren't begging individual merchants anymore. They turned to the Rothschild network, a five-brother banking dynasty that spanned London, Paris, Vienna, Frankfurt, and Naples, with a courier system faster than most military dispatches. Nathan Rothschild, operating from London, understood something profound. Information was money, not in the metaphorical sense, but in the literal, brutal sense. Whoever knew the outcome of a battle, a treaty, or a political crisis first could move capital before the rest of the world even knew there was a reason to panic. With speed and certainty, he created an information advantage that no government could match. And with that advantage, he built the first true international bond market. Instead of lending directly to governments and waiting decades for repayment, he bought sovereign bonds at a discount, then resold them across Europe to a diversified network of investors. It was a simple idea with revolutionary impact. He reduced risk for governments, he increased liquidity for investors, and he placed himself at the center of every major loan issuance. In this new world, a nation's debt wasn't just a promise, it was a product. The Napoleonic Wars provided the perfect proving ground. While governments struggled with slow communication, Nathan Rothschild used his private couriers to move intelligence faster than naval vessels and state messengers. The legendary moment came after Waterloo. When his agents confirmed Napoleon's defeat, Rothschild arrived in London hours, some accounts say a full day, before the government's own dispatch riders. The market didn't know who had won. Panic hung in the air. Rothschild quietly sold British bonds, just enough to signal impending disaster. Other investors saw the move and, assuming Britain had lost, began dumping bonds in fear. Prices collapsed. And at the bottom, when the market was drenched in pessimism, he bought everything he could. When news of victory finally arrived, bond prices surged. That day, he made a fortune not by cheating the system, but by playing it with absolute mastery. It wasn't just money. It was dominance. And the world noticed. By the 1,820 seconds, the Rothschilds controlled more government debt than many treasuries. If a nation wanted to borrow, it used the Rothschild network because that network had distribution. They held the buyers, the sellers, the brokers, the flows. The Rothschilds didn't just finance wars. They helped determine which wars could be fought. They didn't just fund governments, they shaped which governments survived. But the most lasting impact was the web they created, a cross-border mesh of interlocking obligations. Before this, a king could default and only anger a handful of wealthy lenders. But now, a government's bonds might be held by investors in 5 countries, used as collateral by banks in 3 more, and tied to insurance payouts somewhere else entirely. Default was no longer just a missed payment. It was a grenade tossed into Europe's entire financial system. Rothschild's system made debt contagious, systemic, unavoidable. By making government debt tradable, he made government default intolerable. It was the second tightening of the trap. The third tightening came a century later, in America. Under a man who didn't merely influence finance, he choreographed it. J. P. Morgan wasn't a subtle puppeteer. He was a titan who filled the room, a man who could look a banker in the eye and reduce him to silence. By the early 1900s, the United States had grown rich in industry but poor in financial infrastructure. Banks operated independently, money supply was rigidly tied to gold, and there was no central authority to stabilize markets in a crisis. America was powerful but fragile. The crisis arrived in 1907. Stock prices crashed, banks failed, trust evaporated. There was no Federal Reserve, no safety net, no institution to coordinate rescues. Just one man with enough influence to improvise a solution, J.P. Morgan. He locked the most powerful bankers in America inside his private library and refused to let them leave until they agreed to pool funds to rescue collapsing institutions. Under pressure, they complied. The panic subsided. Morgan had acted like a one-man central bank, but he also understood the risk. He was old. He wouldn't be alive for the next panic. America needed a permanent institution that could do what he had done by brute force. So Morgan and his closest allies orchestrated something extraordinary. In 1910, a group of influential bankers and political allies secretly boarded a train under false names and traveled to Jekyll Island, Georgia. What happened over the next 9 days became one of the most controversial episodes in U.S. financial history. Working behind closed doors, far from the public and the press, they drafted the blueprint for a new monetary system, a Federal Reserve that the public would believe served the nation, but that the architects designed to be guided, indirectly yet effectively, by the banking elite. The structure was camouflaged. The institution wouldn't be a single central bank. It would be 12 regional banks. They would appear decentralized. They would appear independent. They would appear public. But the regional banks were owned by private member banks, banks controlled by the very financiers who met on Jekyll Island. And the most crucial power, the power to create money by purchasing government bonds, was placed in the hands of the New York Federal Reserve, the branch whose board was dominated by Wall Street. Congress passed the Federal Reserve Act in 1913, many legislators not fully understanding the implications. Overnight, the United States government gained access to something unprecedented, an institution that could create money out of nothing and use that money to buy government debt. The practical impact was simple. There would always be a buyer for U.S. bonds. Always demand. Always liquidity. The government could borrow without fear of running out of lenders. Debt became infinite. This was the third tightening of the trap, the mechanism that ensured governments would never again hit a natural limit. If markets hesitated, the central bank would step in, printing money to buy bonds and pushing debt ever higher. What had once been a dangerous cycle became the foundation of economic policy. But the world still had one escape hatch left. If a nation couldn't pay its foreign loans, it could default, fall into crisis, and reset. That, too, would soon change. And the man who closed the last escape, the man who ensured the system became global and permanent, was Paul Volcker. We'll continue there. By the time the 1,970 seconds arrived, the machinery built by Paterson, refined by Rothschild, and supercharged by Morgan had already transformed the financial world. Wealthy nations embraced constant borrowing, constant refinancing, constant expansion of balance sheets. For them, the system functioned smoothly, almost elegantly. But developing nations were playing a different game, one that would soon reveal the final piece of the trap. Throughout the 1,960 seconds and 1,970 seconds, dozens of emerging economies borrowed heavily in U.S. dollars. They needed infrastructure, ports, electricity grids, highways, industrial expansion. Multinational banks were eager to lend because interest rates were low and the global economy was booming. Countries across Latin America, Africa, and parts of Asia accumulated enormous dollar-denominated debts. But something else was happening beneath the surface. Inflation in the United States was rising slowly at first, then at a pace that frightened policymakers. By the late 1,970 seconds, U.S. inflation soared beyond 10%. The credibility of the dollar, the anchor of global finance, was slipping. International investors lost confidence. Something needed to break the fever. Paul Volcker, chairman of the Federal Reserve, delivered the cure, one so brutal it would reshape global finance for decades. In 1979, Volcker raised the federal funds rate from around 11% to nearly 20%, the highest in American history. The move crushed inflation. Businesses collapsed. Unemployment spiked. The United States fell into deep recession. But Volcker had restored faith in the dollar, and that was considered victory. The unintended casualties, however, were not American banks or American consumers. They were the developing nations whose debts had been contracted at low interest rates, but were now rolling over at vastly higher ones. Imagine owing billions at 6%, only to wake up and realize your new interest rate is 18%. The math becomes impossible. The interest alone exceeds your national exports. That was precisely what happened. Mexico owed roughly $80 billion. Brazil, $60 billion. Argentina, $40 billion. Countries that had once been rising economic stars suddenly found themselves unable to pay even the interest on their loans. By 1982, Mexico announced it could not continue payments. It was not merely a debt crisis, it was the largest sovereign default threat the modern world had ever seen. Under normal market logic, the lenders would take the losses. Citibank, Chase Manhattan, Bank of America, and others had issued the loans. If borrowers could not pay, the lenders would absorb the damage. That is how risk is supposed to work. But the loans were enormous, so large that defaults from Mexico, Brazil, and Argentina might bring down the entire American banking system. The risk wasn't contained. It was systemic, just as the Rothschild designed web had ensured. Volcker and the institutions aligned with him had a choice: allow the crisis to wipe out the banks that made the reckless loans, or preserve the system by shifting the burden onto the debtor nations themselves. They chose preservation. The International Monetary Fund stepped in as the designated firefighter, but its hoses weren't filled with water. They were filled with debt. The IMF offered new loans to Mexico, Brazil, Argentina, and dozens of other struggling nations. But these loans weren't designed to solve the crisis. They were designed to keep interest payments flowing to American banks, ensuring no major financial institution collapsed. The mechanism was simple and devastating. The IMF provided emergency funds, but only on strict conditions. The debtor nations had to cut public spending, privatize state industries, slash social programs, devalue their currencies, open their markets to foreign capital, and surrender much of their economic autonomy. These structural adjustment programs were presented as tough medicine for irresponsible countries. But the real purpose was ensuring that U.S. banks and later European banks continued receiving their interest. Not a single dollar of debt was forgiven. The principal was not reduced. The interest was not lowered. The burden was not redistributed. The loans were simply extended, refinanced, and rolled over forever. In many cases, the debt grew even larger as new IMF loans were added to previous obligations. The countries were not helped out of the trap, they were cemented into it. This was Volcker's final contribution to the system, the doctrine that sovereign debt should never be forgiven, only restructured in ways that maintain the flow of payments. A nation could be on its knees, its economy collapsing, its people starving, but default would not be allowed. The architecture of the modern world demanded continuity. This cycle repeated across 4 decades. In 2001, Argentina fell again. In 2010, Greece submitted to the same IMF treatment: austerity, privatization, and debt that still hasn't been resolved. In 2022, Sri Lanka collapsed under dollar-denominated obligations, following the same script. The pattern was unmistakable. Debt crises became opportunities to extract influence, resources, and political leverage. Nations could lose control of their currencies, their budgets, their state companies, and yet their debt never disappeared. Restructuring became the new word for perpetual servitude. By the end of the 20th century, the mechanisms were fully welded together. Paterson had created perpetual national debt. Rothschild had globalized it. Morgan had ensured infinite domestic demand through central banking. Volcker had ensured that even when countries couldn't pay, the system would not be allowed to break. It would simply absorb them deeper. Debt was now not just a financial tool. It was a geopolitical instrument, a means of shaping entire nations. But there was still one more transformation to confront. The world had now accumulated so much debt that repaying it, even theoretically, would destroy the global money supply. Debt had become the foundation of currency itself. That is the world we live in today. A world where dollars, euros, yen, and pounds all depend on the existence of government debt to maintain liquidity. A world where financial institutions depend on constant interest flow. a world where default anywhere threatens collapse everywhere. The trap was no longer tightening, it was complete. But to understand why no country can escape, not the United States, not Japan, not China, not Europe, we have to follow the money now, in the present, and witness how every dollar of debt becomes someone's asset, someone's income, someone's leverage. That's where the final revelation begins. By the early 21st century, the machinery built across 3 centuries had reached full maturity. Government debt was no longer a temporary burden or a wartime necessity. It had become the backbone of the modern financial system. Every dollar in circulation, every pension fund, every insurance contract, every major bank's balance sheet depended on one thing: the continued issuance of sovereign debt. If the system ever stopped expanding, it wouldn't just slow down, it would collapse. This is the part few people understand. When the U.S. government issues $38 trillion of debt, most citizens imagine a mountain of IOUs sitting in a vault somewhere, but the reality is stranger. Much of that debt is held not by foreign rivals or secret elites, but by American institutions themselves: pension funds, mutual funds, banks, insurance companies, and above all, the Federal Reserve. These institutions buy treasury bonds because they are considered the safest asset on earth, the foundation stone of global finance. But safe does not mean free. These bonds pay interest, and that interest flows upward from taxpayers to capital holders. In the United States alone, the government pays roughly $1 trillion per year in interest. That money doesn't vanish. It moves from workers, consumers, and businesses into the accounts of the institutions that hold the debt. This is the largest, least visible wealth transfer in human history. It doesn't require new laws, riots, or revolutions. It happens automatically, predictably, endlessly. And here's the detail that makes the system mathematically impossible to unwind. Roughly half of U.S. debt is held internally. Social Security, Medicare, and other government-run programs have lent their surpluses to the Treasury, receiving Treasury bonds in exchange. Which means the government owes money to itself, but in a way that still requires taxes. When Social Security needs to cash in those bonds to pay retirees, the Treasury must raise new taxes or issue new debt to cover the payment. The left pocket owes the right pocket, but both pockets ultimately draw from the same pair of hands, the taxpayers. Globally, the pattern repeats. Japan owes $9 trillion, but most of that debt is held by Japanese institutions and the Bank of Japan itself. Europe owes $14 trillion, much of it absorbed by European banks and the European Central Bank. China, too, holds massive quantities of its own sovereign debt through state-owned banks. Every major economy is running the same playbook. Because the players hold each other's bonds, Japan holds the United States debt, the United States holds European debt through the IMF, Europe holds developing nation debt through the World Bank. The system becomes one enormous circular chain. Everyone owes everyone. No one can default without hurting themselves, and the interest flows upward through the entire network. This interlocking architecture ensures stability, but it also ensures captivity. The world cannot stop issuing debt without shrinking the global money supply. And shrinking the money supply means deflation, collapsing banks, mass unemployment, and political upheaval. If the United States government paid off all its debt tomorrow, the result would be catastrophic. Treasury bonds would disappear from pension funds, banks would lose their safest assets, and the dollars created by debt issuance would vanish from circulation. Economists don't say this out loud, but the truth is simple. The dollar exists because U.S. debt exists. The same is true for every major currency. That is why governments never pay down debt. They roll it over. They expand it. They rely on it. And central banks guarantee that there will always be a buyer. Whenever demand weakens, the Federal Reserve steps in and purchases bonds with newly created money. This isn't a glitch. It's the core feature of the modern financial order. Now, consider what this means for wealth concentration. The largest holders of government debt are not individuals, but massive asset managers. BlackRock, Vanguard, State Street, Fidelity. They control tens of trillions of dollars on behalf of pensioners, corporations, governments, and wealthy families. When the U.S. pays $1 trillion in interest, these institutions collect a substantial share of it. Through them, interest payments concentrate wealth upward, silently and mechanically. It isn't called a tax, but it functions like one. The government collects money from workers, then distributes it as interest to bondholders. The system taps the bottom and fills the top. And because default anywhere threatens collapse everywhere, no country is allowed to escape. Not Greece, not Argentina, not Sri Lanka, not anyone. This is the part of the story that reveals the cruel elegance of the architecture. The four men who built the system never met. Paterson didn't know Rothschild. Rothschild didn't know Morgan. Morgan never met Volcker. They didn't conspire across time. They simply solved the problems in front of them, problems that all rewarded the same type of solution. Every reform that stabilized the system also entrenched it. Every innovation that made debt easier to manage made it harder to escape. Paterson made debt permanent. Rothschild made it global. Morgan made it infinite. Volcker made it inescapable. Together, they created a world in which debt isn't just a financial tool, it is the foundation of civilization. The bridges we drive on, the hospitals we visit, the wars we fight, the currencies we use, the retirement accounts we depend on, all of it rests on a mountain of perpetual debt. You cannot remove it without removing the world built on top of it. This is why policymakers panic at the idea of balanced budgets. This is why every attempt to reduce national debt sparks recession fears. This is why nations borrow more in crises, not less. The system doesn't malfunction when debt rises, it malfunctions when debt stops rising, and the people who benefit most are not governments or taxpayers. They are the institutions that hold the debt, manage the debt, and collect the interest. To them, $38 trillion isn't a warning sign, it's a business model. Every dollar of government debt is an asset on someone's balance sheet. It pays interest. It serves as collateral. It can be repackaged, securitized, borrowed against. As long as confidence holds, as long as the world believes, the United States, government will pay interest. Even if it never pays principal, the machine keeps running. The trap is not a cage made of bars. It is a web made of obligations, soft, invisible, and unbreakable. Nations are not prisoners of another nation. They are prisoners of the system itself. And the final truth is the one almost nobody wants to confront. We are all inside it. Our pensions depend on it. Our currencies depend on it. Our governments depend on it. And the architects who built it knew a simple fact. A world in debt is a world under control. But the story has one last turn, the philosophical turn. Because once you understand the architecture, the question shifts from, how did this happen, to something far more unsettling. What does it mean to live in a world where debt is not a flaw of society, but the cost of participating in it? You've now seen the architecture, the beams and pillars that hold up the invisible structure surrounding every economy on Earth. But the final step is understanding what it means for us. Because once the mechanics are exposed, once the gears are visible, the question shifts away from history and towards something far more personal. What does it mean to live inside a machine whose fuel is perpetual debt? What does it mean to be born into a system designed long before you arrived? Designed in ways you never voted for, designed to keep expanding long after you're gone. Most people think debt is a flaw, a policy mistake, a political failure. But the truth is stranger. Debt is the operating system. It dictates how governments behave, how markets respond, how central banks intervene, how nations negotiate, and even how societies dream about the future. Every promise a politician makes, healthcare, education, military jobs, is denominated in debt. Every crisis, every recession, every bailout expands it. Every attempt to fix the system accelerates it. The world doesn't run on money. It runs on liabilities that must be rolled over forever. And here's the part that creates the deepest illusion. When people hear the country is in debt, they imagine someone else on the other side of the ledger. But the system is designed so that the creditor and the debtor are the same entity. The world owes money to itself, but the benefits and burdens are not distributed equally. The interest flows upward while the taxes flow downward. We don't see it because no one collects it with a gun or a badge. It leaves silently through payroll taxes, business taxes, income taxes, fees, inflation, and arrives silently in the balance sheets of institutions holding the bonds. This flow feels invisible because we've lived with it our entire lives. Nobody riots over interest payments. Nobody protests the transfer from taxpayers to bondholders. It happens without drama, without speeches, without television coverage. Yet it reshapes society more than almost any policy ever passed. $1 trillion a year leaves workers' hands and enters financial institutions. Multiply that process across every developed nation, across decades, and you begin to see the scale of the machine we inhabit. Now imagine trying to escape it. If a government tried to pay off its debt entirely, the currency supply would contract so violently that the economy would collapse. Banks wouldn't have safe assets. Pensions wouldn't have anchors. Money markets would evaporate. Businesses wouldn't be able to borrow. The heart of the world economy, liquidity, would vanish. The system requires more debt, not less, just as a living organism requires blood pressure to survive. Pressure too low is fatal. Pressure too high is fatal. The trick is sustaining the flow, and because every major country is inside the same structure, there is no outside. There is no safe zone. Even powerful nations, the United States, Japan, China, members of the European Union, operate on the same rules. They all borrow. They all refinance. They all feared deflation more than debt. They all know that the financial markets would punish any government that tried to genuinely shrink national liabilities. In a world built on credit, responsibility becomes a threat, not a virtue. This is why every crisis from 1929 to 2008 to 2020 ends the same way. More debt, bigger balance sheets, larger central bank portfolios. Each shock reveals that removing the support beams would collapse everything above them. So the beams multiply. The scaffolding grows, the system becomes more complex, more delicate, more interconnected, more impossible to unwind, and we return to the four architects not as villains, not as conspirators, but as craftsmen who solved the problems of their time in ways that created the problems of ours. Paterson saw a kingdom without funding and built the first perpetual national debt. Rothschild saw fragmented financial markets and unified them into a global web. Morgan saw a chaotic banking sector and created a central authority with infinite purchasing power. Volcker saw inflation spiraling out of control and created a doctrine that made sovereign default unacceptable. None of them set out to build a trap, but each of them built a part of one, a system where governments never stop borrowing, a system where interest never stops flowing upward, a system where default is unthinkable because the consequences are unmanageable, a system where escape is mathematically and politically impossible. Today, the world carries $315 trillion of debt, but the number itself is almost irrelevant. What matters is the structure, the incentives, the flows, the dependencies, the design. Because once you understand that the system is functioning exactly as intended, you realize something uncomfortable. Debt isn't a mistake. It's the foundation. Interest isn't a cost. It's the rent we pay to participate. And the machine isn't broken, it's complete. The irony is that the deeper you study this architecture, the more you understand why nothing ever seems to fundamentally change. Why governments argue but never solve. Why crises come and go but the debts remain. Why politicians talk about responsibility but choose expansion every time. They aren't lying, they're trapped too. We inherited a world shaped by centuries of financial evolution, a world that functions, grows, and stabilizes through perpetual obligation, a world where power does not reside in those who make decisions, but in those who own the claims, a world where the most influential force isn't a king or a president or even a central bank, but the silent, compound pressure of interest. If this changes how you see the system, then you're finally seeing the invisible architecture beneath the surface, the part nobody teaches in school, nobody discusses in public, nobody campaigns on. Because the moment you understand it, the narrative shifts from how do we fix it to something far more disquieting. Was it ever meant to be fixed at all? And that is the truth hidden in plain sight. We are not living outside the machine. We are living inside its design.